On the record rally as the S&P 500 heads for its third straight winning week. Let's ask our panel. Joining me now is PNC's Young-Yu Ma, HSBC's Max Kettner, and Ned Davis Research's Ed Clissold. Happy Friday, all. Young-Yu Ma, straight to you on this one. Some signs, perhaps, in retail sales, maybe in some other indications, although the top-line numbers look good, that the working-class consumer might be feeling some stress. Is that anything to be concerned about, or is the strength of overall earnings still carrying things through?
Thanks, John. It's great to be here. I'm actually not that concerned about retail sales. I think we saw some elements where spending is healthy in discretionary areas such as restaurants. We see strong data out of credit card spending. I don't think consumers are going to be what holds this rally back. I think if anything holds this rally back, it would be if interest rates, long-term interest rates in particular, continue to rise higher from the levels where they are today. That would be more of a headwind I'd be concerned about than retail sales. I think those will hold in well based on the wealth effect, based on spending by the upper income and wealth levels, and by retirees dipping into savings.
Ed, the new Fed chair, Kevin Warsh, seems to be trying to take the Fed's desired action a little bit more out of the equation and let the market do its own thing. So when you think about the impact of interest rates on markets, is it so much Fed watching as it used to be?
Well, I don't think Fed watching is the name of the game for long-term rates. It's really where supply and demand meet here. And there's just a lot of supply that's coming to the market, both, of course, from the U.S. Treasury, but also corporations. Corporate debt is at record-breaking levels. Last year was a record level. This year is far surpassing last year's record levels. And the capital markets are deep. The U.S. capital markets, the global capital markets. But at some point, they're going to start showing strains. That strain is going to take place in the form of longer-term interest rates pushing higher, especially when we have oil prices elevated as they are today.
Ed Clissold, give me your take on that as well, especially since you like data center electrification and power as a theme, and a lot of what's driving that is some of that debt that Young-Yu Ma was just talking about.
Well, yeah, Warsh would love to have less pressure on the Fed and what the Fed speak and parsing out individual words in their statements. So I think it does put the long end of the curve more in play. If we get above 5% of the 10-year, I think that could be a real challenge for the equity markets. And so in terms of what this means for this long-term AI play, and we think over the next few years, this has a ways to go still. But it does mean that over the short term, if there's concerns about the pace of the Capex investment, how much it's going to cost those companies, you could see some pullback, which is why we think between now and the end of the third quarter, there could be a pullback in the broader equity market as we try to digest everything going on with the Capex story. And it is more related to the Fed than it has been in years past.
Max Kettner, you seem to be saying that overseas is a good place to look for investment in this environment, not just U.S.
Yeah, look, I don't think it's just the US, but I think actually that when we look at what happened in June and July, that clearing of momentum positions, that clearing of tech positions, a bit of excess leverage taking, really that should be paving the way for a bit more tech exposure away also from the US. It's not just the US, it's also leaning back into some of the Asian equity universe. I think in Europe, while Europe is mostly really an expression to broaden the rally and to play a broadening of the equity market, I do think within the European equity universe, when you look at the likes of the banks, actually, they still look fantastic. When you look at the earnings picture, you look at earnings revisions, any kind of sign of a re-steepening of the bond yield curve should really help European banks. So it's not just about the US, it's also some tech exposure outside of the US in Asia, and even in Europe, I think particularly the banks look great value.
So you mentioned particularly the banks, Max. Where else would you go within Europe? Because for a while, those markets were less exciting.
Yeah, I think actually, but when you look within Europe, right, when you look at the European equity universe, you track that against, for example, things like the equal-weighted S&P. That, for the best part of the last 2.5 years, has been pretty much the same line. So again, if you want to be playing the broadening, that actually things like cap goods, when you look at the manufacturing cycle picking up and the manufacturing cycle also actually broadening away from not just AI capex, but to broader capex, All of that actually within the industrials, for example, is a pretty good complex. And also when you look at the tech exposure within Europe, right, some of the smaller companies, particularly when compared to the US and the behemoths in Asia, actually smaller companies in Europe on the AI universe, again, look pretty decent value.